Welcome to episode 32 of the Corporate Real Estate Insider Podcast. We have a super fun show today. I'm not joking. It is going to be fun. We are kicking it off today with property tax assessments. Brian, take us away on the world's most interesting topic.
So yeah, Tucker, that's a tough intro. It's typically not that fun of a topic. It's typically something that people gloss over in their lease, and we're going to make it important because with what we've been talking about over the last year and a half, the reduction in value in all property types, but significant reduction in value in the office sector, that is going to and has started to trickle down to what the value of those buildings is bringing for revenue to the cities. So the cities and towns, namely in this example, Boston, their city council is calling for a special committee. They're calling for hearings to talk about the impact in the reduction in revenue to the city because of property tax values or building values are driving lower property taxes. So what does that mean for us in this world? It means that the values of the buildings are going down significantly, some cases 20, 30, 40%. That's going to drive a 30% reduction in building value in the article I was reading will drive about $1.5 billion in less revenue to the city. So a significant amount of reduction in value. So how does that translate to commercial leasing? Well, the process of abatements of cost. So in a lease, you have the ability to go for tax abatements. You also have the ability to have leases, properties reassessed. And that reassessment process will ultimately drive a lower tax base and will flow through to a lower cost to our clients and everyone listening to this podcast. But there's some nuances to that. Leases have to allow, especially gross leases, allow for the value reduction to reset the base cost that's in a gross lease. So if your base year taxes are set at simple numbers, $10 a foot, based on a value that's 30% higher, you have a reassessment of the value and that base comes down to maybe $7 or $8, maybe $6. Well, if your base year is set and you don't have language in your lease that allows you to capture that value, effectively what you're doing is giving your owner the upside value of that reassessment. And many years ago, I was working with a client and they had a single tenant, 100,000 foot office building, suburban office building. And they went through this exact process. It was after the telco bust. The market was completely decimated in this particular area. And to the tune of like $6 million in value was on the table in terms of the tax reduction based upon what they were paying versus what the actual cost was in the lease. And it went all the way to attorneys. We threatened a lawsuit, but it was bulletproof. The lease did not allow that value to be passed through back to the tenant. So in the process, the landlord was getting to pay the actual value or the actual tax bill, and then the tenant was reimbursing based on a much higher perceived value in the base year. So one, we should be very clear in our leasing to make sure that we're capturing this value. And two, landlords aren't going to go do this on their own because a lot of times they're not incented through a fully leased building or a mostly leased building to go and capture the value. So make sure you have the rights in the lease and then go back and make sure you're forcing your landlords to go through the process to reduce your cost.
Good advice there. In regards, I think most of your comments were related to tenants that are in a period of their lease. Let's say it's year 5 of a 10-year lease, or it could be whatever. I think it's also worth noting that as values continue to fall, I mean, I read an article that said Washington, D.C. commercial real estate tax revenues fallen, or the values of their office building submarkets have dropped to like $1.5 billion of assessed value in the past few years. So do you think what that does for the tax base erosion in the DC market? But where I'm going with this is like, besides what you might have in your lease or might not, keep in mind if you're renewing a lease for a 2024 transaction, I'm not allowing landlords to give us a 2024 base year. Not only is it still only March, but the assessed values of these buildings is going to likely fall even into next year. And so I have landlords agreeing to 2025 base years, or in some cases, when we're doing something early, a 2026 base year, for further protection for my client. Not to mention getting language that allows us to, benefit from any sort of reduction of tax assessment, like Brian was talking about. But just because you're signing a lease in 2024 does not implicitly mean you have to agree to a 2024 base year. So keep that in mind as you're negotiating renewals, or for that matter, new leases that include a base year for transactions to be signed, in the next 9 months.
Okay, let me add to this conversation. In fact, there was an article that came out just today in CoStar called "More Tax Appeals Expected as Divide Widens Between Office Valuations and Assessments." A couple highlights out of this just to accentuate how big of an issue this is and is going to be. Office values across the United States have decayed by as much as 15% since 2021, according to CoStar analysis. That decline has translated into more than $664 billion in lost value for the national office market between 2019 and 2022. Wow. Okay, so here's some San Francisco specific stats. Lost commercial real estate tax revenue in San Francisco, for example, is projected to contribute to a shortfall of as much as $1 billion over the next few years, as office buildings sell for a fraction of their previous price. The number of commercial and residential property tax appeals in San Francisco in 2020 was 1,260. In 2023, it was 6,835 property tax appeals. And let me give a little bit more background. It does get complicated pretty quick. In California, I think most people know we have this thing called Prop 13, which limits the increasing property taxes to the last transaction value, 1% of the last transaction value, and it's allowed to go up by no more than 2% per year. So that limits to the upside. What we use to do these property tax appeals is called Prop 8. And what's interesting about a Prop 8 tax appeal is that you have to do it annually. It's a temporary tax reduction. So that landlord has to be going in every year and appealing for that property tax reduction. I don't know if it's done differently in all of your markets, but this is going to be a very big deal. And the last thing I'll point out, it gets complicated so fast, but I think this is one of the places where operating expense cost pools can be problematic, where you have a big reduction in the property tax, but it doesn't offset your operating expenses because it's just contained to the property tax pool of operating expenses. And so you're still paying this big increase on the other pools of operating expenses. What do y'all think?
It's important to make sure you understand the components of that, right? So I think a well-negotiated lease, you really have to spend time in the tax and operating section. And, I have a particular client that I've worked with for a long time that has taught me a lot about how these clauses are so impactful to the underlying total cost of a lease for a tenant. And, the tax portion of it has been, I wouldn't say neglected, but put less emphasis on it because it's pretty easy to get some of these protections we're talking about. Typically, it's reasonable. There's not a lot to it, but the operating expense side is important. And John, to your point, the more you can break that out, so you know the specifics around each line item, the more value you can create when situations arise. You can break it down to its components and then be able to capture the value rather than have it be lumped into some large sum or a large pool of cost. And from a landlord's perspective, it allows them to kind of gray the waters a bit, right? So you kind of lump everything together, and it's harder to find mistakes. It's harder for tenants to unwind it. So I think the more clarity, the more of a line item breakdown. I mean, in some of our RFPs, I know myself personally, we'll put the operating expense clause for larger leases in an RFP could be 3 pages. And, more could be 6 pages in some leases, because you want to get to that, to that level of definition, because there's so much cost, especially the way that costs are rising right now. There's just so much cost associated with this. And I think we need to do that with a bit on the tax side. We need to start, Owen, as you were talking about, early renewals, which are really popular right now, and they should be, because you can front load value in a declining market. So tenants can capture some savings, in 2024 for a lease that doesn't expire for 2, 3, 4 years. And if if the situation is right and they're not sacrificing short-term gains for long-term cost, meaning they know their occupancy is right, or you can restructure your lease early to give back the space you don't need, you don't want to give it up on the operating expense or tax side, right? So one of the things that I've done many years ago is you don't set your tax base to 1 year. It's kind of like a new development, or if you're doing a built-to-suit, you can, and this is something I haven't done for a renewal, but it's something I think we have to really explore, is to say, okay, look, we don't want our tax base to be 1 year. We're going to phase into this tax base. So we're going to use the average of the next 3 years, or the average of 20, say if it's 27 renewal, 20, fiscal year 26, 27, 28, or 28, 27, 28, 29, because we don't really know when this is all going to shake out. We don't know where the bottom is. So why set it to 1 year? Let the market tell us what it is, and we'll use a process in an equation to get you to the right base that'll ultimately be in the lease for many years to come. So that's an interesting way to do it that we've done through, in a built-to-suit, when you don't have a tax base that you need to assess. But maybe it's time to start pulling that forward into situations where you're doing early renewals.
Yeah, operating expenses and taxes are so important. I feel like a lot of times neglected a bit, and particularly on larger transactions. I mean, I know all of us have seen leases that other people have done that are, inherited clients of ours, where it's a lease we weren't involved in. We're looking at the operating expense language going, what happened here? Like, this is an absolute mess. And it's such an opportunity. And I think that there's this misconception that operating expenses and taxes aren't as negotiable as other provisions in the lease are. These are negotiated items, right? The whole idea of a base year, or what can be charged or what cannot be charged, this is all a construct that real estate professionals have invented to try and make doing these leases simpler. And you can negotiate these things. The other thing that I wanted to mention is that related to taxes specifically, just given that we were in this cyclical bull market from, call it, 2010 to 2020, I think it's very common in the later stages of a bull run for people to think, oh, you know what? I don't need to even really worry about the ability to capture value in a downward reassessment, because that hasn't happened in a long time, right? Like, people have this tendency as time goes on to forget, oh, wait a minute, that was really important in 2008, 2009. I need to make sure that we're ready for when this next thing comes. And when there's so many next things that theoretically could come, it's hard to protect against all of them. But to be doing a really good job advising companies on their corporate real estate, I mean, that's literally the job, is to predict what are these things that can happen. How do you sort of risk manage all these different factors and create the most protective lease that you can? The last thing that I wanted to mention here is that operating expenses and taxes are also critically important, not just from a cost standpoint, but from actually a building management standpoint, right? For any of these larger leases, I really believe that companies, even if they don't plan to do these things, that they should have the flexibility to do these things to self-manage their own building, right? You should have the ability to recapture in a very large lease, being able to do your own janitorial, your own landscaping. You should have the ability to do your own security, your repair and maintenance things, all of that. You should be able to say, hey, wait a minute, we're pulling this expense out of the base year or out of the landlord scope in a triple net lease, and it can be performed by tenant. And as long as the tenant is performing it in a manner that's consistent with the quality of building and all that, then that should be permitted. And in that scenario, landlords should not be able to charge for those services at all. And I found that that's a great way to either exert greater control over the asset, but also secondarily, even if you don't want to manage the asset, to be able to have great leverage to negotiate for better pricing and say, hey, you know what, if this is really the best you can do, we're going to do it ourselves. So something to keep in mind.
One last point on this whole conversation about operating expenses and property tax appeals. It occurs to me that it's always important, and maybe never more than the next few years, to audit the landlord's operating expenses at the end of the year, rather than just assuming that they were done properly. if you don't know exactly how to do that, hire a company to do a proper lease operating expense audit when you get your landlord's reconciliation statement for the end of the year. Somebody should be looking at the way they did it and cross-checking that against the language of the lease. It's going to be really important with all these changes in the operating expenses.
Yeah, I think, Tucker, to go back to your comment that this stuff was neglected a lot of times in the bull market we've had, I don't agree. I think brokers run away from it because they don't have the knowledge to actually negotiate it properly, and they're exposed. They don't understand it, and there's very few of us that really can dig in on it and truly understand all of these different pieces that in the components of an operating expense clause or a tax clause. And when you listen to our listeners, if you have brokers that aren't going to dig in on this stuff, it's probably not because they don't want to. It's because they're afraid to, because they're exposed. And it's a really tough place to be as a client, but it's important to understand and recognize it, because there are a lot of brokers that just don't have the knowledge or the experience to capture the concepts that we're talking about. And there's probably somebody on their team that can. I'm not saying you got to change brokerage firms. That's certainly an option, but it's probably because you've been you're working with someone who just doesn't have the experience to do it. And I would push for somebody else on the team to step in and help.
I'm gonna split the difference on both your opinions. Tucker's is that people just forgot what it was like in 2008. Brian, you blaming brokers for poor performance. I'm going to suggest it could be a combination of the both, or just the environment you're negotiating within. And so during the bull market, there are landlords that are very well stabilized their portfolios. They've got a lot of demand for those looking for space in their building, and are just reluctant to even go there. It's not to suggest they're going to provide something that is just completely asinine and unacceptable, but in a very, very tight market where we all came from before the pandemic, where we saw office vacancies in certain submarkets, sub 5%, landlords are just more reluctant to even go there than it is today, for example, when a third of all office space is available. And so to Brian's point, bringing this stuff up early, while albeit some might consider it onerous for an RFP or an initial proposal, kind of vets out whether or not that landlord's willing to play ball with these matters. And if that's something that's so important to you or your client, that's where you can say, well, we'll find somebody else that's willing to play ball. But I imagine there are cases where all of those things we just discussed rang true, where people either forgot what things were like in 2008, either the broker wasn't knowledgeable or astute enough to be able to go down this road of negotiating operating expense provisions, or in some cases, despite the broker's efforts, it was a building that was a premier asset with single-digit vacancy, and landlord just was reluctant to even go there.
Yeah, I think that there's a lot of scenarios where there's protections that everyone would recognize, or maybe not everyone, but the majority of the brokerage community would recognize are important to get, and you're just not able to get them, right? No matter what effort you make. And there's instances where, like for example, say you're a 100,000 square foot tenant in 2021 in a Link Logistics, which is Blackstone's industrial real estate arm in Southern California. Like, it was not even worth spending the time and energy asking for property tax protection, because there might be literally zero Link Logistics tenants in Southern California that actually have property tax protection. So do you want to, negotiate something that no one is getting, that they will say, absolutely not, we will literally walk on the deal over this? Well, when it comes to that type of scenario, it's less about, like, did you get the protection? Because in certain instances, it's an impossible task, but rather, did you make sure that your client really understands how the cost structure will change when the building sells? There's a very large third-party logistics company that we work super closely with, and we literally got this account because somebody didn't negotiate for property tax protection, which they wouldn't have been able to get anyways. But most importantly, they didn't tell the client about it. And what that third-party logistics company could have done if they were aware that there was massive property tax exposure is they could have gone to their customers and said, hey, great news. The tax basis on this building is really low. And as a result, we can pass on this massive tax savings to you. That said, when the building inevitably sells, and that might be a month from now or 6 months from now, or it might not even sell at all, but when it sells, we'll be able to show you that it sold. and we need you to pay property taxes at the higher rate. And then it becomes this, hey, win-win. We're getting savings, you're getting savings, everyone benefits. But instead what happened, this building sold and increased the actual, like, all-in expense of occupying this building by hundreds of thousands of dollars a month. And granted, it's a very big building, completely destroyed the profitability of this entire warehouse operation for this company. And they're like, we're done. We can't work with these people. They're incompetent. So it shows how critical this is, and the impact that it can have on any business.
You just made my point, Tucker. That was not a situation of somebody neglecting it. That was just someone being incompetent and probably didn't understand it enough to raise the issue. It's true. And unfortunately, this business is full of a lot of people like that I wouldn't think that they're doing it for the wrong reasons. Like, if they knew it and understood it, I would assume people would bring it up to their clients. They just don't get it, and it's not their fault. But the interesting part about all this, and just let me go where I'm going here because it's good, is what does this mean? What does this mean to actually the delivery of services in these cities and towns, right? Think about every city and town across the United States, right? So this is 2024. It's an election year. Politics is on the front page of every newspaper, right? Certain parties control certain cities. All of that doesn't matter. It doesn't matter at all. The basic services of a city are going to get delivered one way or the other. Now you just cut 30% out of the budget. What happens, right? So if you're a tenant occupying space in a city or a town, especially ones that are having challenges already, and you're worried it may be not to a point where it's going to impact your business yet, but what happens if 30% of city services get cut because budgets just went down? Because property taxes drive a lot of the value, or a lot of the services. They create the revenue to drive the services for these cities and towns. And it doesn't matter who's in power on the politics. Take any party or no party. It's still the core of the city needs to be delivered and needs revenue to do that. And real estate taxes is a major portion of that. So if the city of Boston loses 30% of its revenue, I'd be really worried about, we have major issues with our public transportation infrastructure right now, to the point where one of the lines has been shut down and another one's been throttled back where I don't think it can go over 10 miles an hour on anything. So a commute that used to take you 15 minutes now takes you 45 minutes on the Red Line train. It's falling apart. And now you take 30% out of their budget. Like, it's scary where this is going. And it hasn't gotten to the point where it's part of the assessment yet. Like, this particular, like, where are we going with this particular city? It's more about where it is today, I think, in terms of our assessments with some downtowns. But I think we need to spend more time thinking about this in very strategic locations or very strategic offices about making commitments in certain municipalities that are going to have issues or are starting to show issues, right? And I don't know where we're going with it, but it's scary, in my opinion.
By the way, to your point, property taxes collected at the county level, and one of the biggest uses of those funds is schools. So that's a brutal story coming next. Well, I don't know about you guys. I've talked about property taxes as much as I want to. I've got a challenge to the group. This story, again, came out on CoStar. Some guys put a building on the market for sale. Pretty ordinary stuff, right? Except here the headline, Amazon leased office hits the market in test of investor confidence. Okay, so this is a group called Strategic Office Partners. They've got a building in Tempe, Arizona. It's leased entirely to Amazon. The building's 123,500 feet. Amazon originally moved in 2015. They renewed the lease, I believe, twice, and they say they have slightly more than 5 years of term remaining. Okay, so these guys are putting an office building on the market as a leased investment in Tempe, Arizona, leased to Amazon, presumably a credit tenant. In normal times, that's a cap rate problem to figure out what the building sells for. I think our audience is going to understand cap rates. It effectively determines the return you get because the NOI, the rent the tenant pays, is fixed. So the cap rate becomes variable. That's the return you're going to need from that money when you buy that building. And so my question to the group is, with 5 years of term, they have a couple more renewal options, which they may exercise, they may not. What's the cap rate that building in an office building in Tempe, Arizona trades for? Because that tells us a lot about investor confidence, investor expectations. I'll save my answer to that question, but throw that to the group. What should it trade at? What will it trade at? What would you pay? Like, what's the cap rate on a 5-year Amazon single tenant net leased office building in Tempe, Arizona?
Yeah. So my opinion is that there's no cap rate at which the investment community would underwrite this building today. I think you have to look at it differently. One is you're not going to be able to put debt on it. So your unlevered return on it, or your unlevered IRR is the only thing that you can really look at. And if, say you had a $20 triple net rent, and at 123,000 feet for 5 years, that's $12 million in rent. I think if you take the $12 million, you do a net present value calculation of that revenue, and you get to some sort of a value for that revenue stream. And then you have to value the vacant 123,000 foot office building as a vacant 123,000 foot office building at some, market value. Maybe it's worth $5 million. Maybe it's worth $50 million, but it's probably not if my guess on a net rent is correct, which $20 a foot sounds about right. Maybe a little light. But in my opinion, an 18 cap on $20 rent is $13 million, and I don't think it's selling for that, right? I don't think it is, unless I have another opinion, and this is where the banks are starting to get smarter, and where the market is starting to see these kind of vultures out there. And I wouldn't be investing in these funds, but they're fee buyers. So we've got a couple of them here in Boston that have kind of operated, and they've actually made a lot of money on the underlying assets, but it's not their strategy. And this is where you have to be worried, because their whole strategy is to get the building at really any cost, because they're not using their own money. It's all foreign capital or investment capital, but it's all equity capital or a big portion of it. And then later on, they'll lever it up. But they really don't care, because it's not their money. And these buyers will then go and have asset management fees. They'll have property management fees. They'll have in-house leasing fees. They'll put a fee on top of the fee and the fees and the fees and the fees, and their whole investment strategy. And those go to a separate company. So they've got this management company sitting on the side, and that management company is collecting all these fees, and that is the entire strategy of this type of owner and this class of owner. So you're going to start to see a lot of them start to materialize. There's a particular one here. I don't understand how he raises money, because he got wiped out, I think twice, but I know for sure once, and then partially twice. Completely gone. Like, the market took his buildings, the banks took everything back, and then you hit another cycle, and he's back raising money, back buying buildings, back before the interest rates went so high, levering the buildings as high as he possibly can, and just taking fees on everything. And that class of buyer, they love this, because you can control a lot of square footage. You can buy a lot of buildings, and if you have any tenants at all, you just collect fees, and then anything you lease is gravy, because you're getting a leasing fee on it, you're getting an acquisition fee on it, you're getting a management fee on it, and all this is what drives the revenue for these owners. So, it's not an investment; it's a fee generation vehicle.
It's going to be challenging. I mean, it's everyone loves Amazon credit, but it's a cautionary tale, one that has already played itself out in Seattle. Amazon had a 539,000 square foot lease in a building called West 8th here in the city. It was traded in 2016. DWS bought it. Again, at the time, it had approximately 9 years of term left with Amazon. And in 2021, Kilroy paid $490 million for it, assuming in large part that Amazon would renew its lease. And guess what? It didn't happen. And so now, unfortunately, Kilroy, who paid, top dollar for this Amazon asset, probably underwriting that 80% renewal probability, it didn't come to fruition. And now the property is, nearly entirely vacant, will be entirely vacant. And as to the prospects of finding tenants for the building, pretty grim. Like we've talked about countless times in this pod, given the lack of demand for office space right now. So I'm with Brian. Like, I don't think it trades for necessarily a particular cap rate relative to comparables that have traded in the neighborhood, but rather somebody looking to be opportunistic, saying, hey, I got 5 years of term left to figure out what we might do with this asset downstream. But I would be underwriting nearly a zero probability that Amazon renews that lease. Maybe they will, but not based on what history has shown us, even when these buildings have been literally on the doorstep of their own campuses, like that case in Seattle.
I'm blown away by that. And I think you could be right. But what does that say, right? That there's no return. You don't trust the future. So tell me again, what was your residual value for the office building?
The residual value is next to zero, I think, and I don't know the Tempe market very well, but I know that it's not the core market between Phoenix and Tempe. Tempe is, I believe, or at least used to be, kind of the secondary market out there. So my guess is that it's not worth very much as a vacant office building, right? And then you start to look at where buildings have traded, it supports that. So maybe it's, I don't know. It's close to zero on the residual value because you're getting it in 5 years vacant.
Let me add another detail. The building recently underwent more than $16 million in capital improvements. That's $130 a foot.
I don't think it matters unless that building is the, class A plus, perfect location and is able to backfill tenants quickly. It's just such a binary outcome, right? Either the tenant renews and your building's worth a ton, they, re-sign for 10 or 15 years, and then you can finance it and you can sell it at a market cap rate. Otherwise, they vacate and that building might be empty for 3 or 4 years. You're going to have to invest a ton of capital to turn it from a single tenant building into a multi-tenant building. I mean, it's brutal. These types of single tenant office deals went from being, some of the most attractive that you can find as a buyer, right? Like consistent cash flow, almost like a higher yielding type of bond with depreciation benefits and things like that. And that's just simply not the case anymore, right? This building would sell at a much higher price if it were 30 or 40% leased to Amazon and the balance of it were leased to a bunch of random small companies on variable lease expiration dates. Because at least then it'd maybe be financeable. At least then you would have enough occupancy to be able to cover your fixed expenses for the entire project. But yeah, and binary outcomes like this with short, average, lease duration left, it's really tough.
So I'll give you where my opinion comes from. Recently in a market here that, you probably could equate to Tempe, I don't know, called Quincy, Massachusetts, named after, our second president of the United States. No, he wasn't the second. He was John Quincy Adams. So whatever that was. Anyway, the building, 200,000 square foot office building, sold in 2018 for $43 million, went through extensive renovations, more recently added an amenity center, added a number of amenities, a number of improvements to the building, just sold for $6 million. So, the numbers are just staggering, right? And there's leases in there. It's not vacant. There's some tenants in there. There's revenue. I don't know the particular underwriting of the tenancy, but it's staggering how much value in these tertiary office buildings that are becoming back to market, even with some tenants in them, are worth. One, you can't get any debt on it, right? So the building has to be bought with all equity. Two, the market is not supporting any of the rents where they used to be. So values have eroded massively, even if it was leased, because your renewal probability is down and the rents in the renewal are significantly down. Just kills your IRR. And third, nobody wants to get in this game. Who wants to sit on a building for years and years, right? So it's distressed buyers, or it's like I was saying earlier, it's for buyers that are just looking to collect fees. And I don't think it's good for the market under either scenario, but the realities are there's significantly more kind of commodity office space that'll ever get leased ever again. And some of these buildings are just going to go away.
So I think you guys are all too pessimistic. And we've talked about this before on the pod, so here's my prediction. And the buyers that do move in are the local builder investors in that local community. That's what we've seen in San Francisco. who fundamentally believe in the long-term viability of an office building as long as you're in at the right price. And they're going in and buying these buildings at 40 cents on the dollar. And so there's going to be a local Tempe builder, developer, investor, owner who sees some residual value in this asset. And so using your math, by the way, a question for you, Brian, what do you want? What interest rate are you using in determining your NPV today?
10%. Yeah, it's high single digits probably. But the other part of it, John, like think about this. What's the carry, right? There's a story here about this office building many years ago that was bought for like under $1 million. It was, I think, 600,000 or 800,000 feet. And everyone was like, wow. They sold it for $100 million a few years later. And they done some leasing and done some improvements. But the real challenge is you're buying a building that when you get it back, you got to pay the taxes on it. You got to pay the operating expenses on it. You got to manage it. Your insurance doubles at least when it's vacant, right? It's a lot harder to insure a vacant building than it is one that's occupied. So these owners, yeah, your small construction company come in, but when the building gets big enough, those small owners get scared away because the carry costs get too high and they can't float it without partners, and then it gets complicated. So I get what you're saying, but and do you want to be stuck paying for a building that's vacant with, one tour in the last 6 months? Good luck. And then tenants get scared away because they're worried about what the unknowns are, right? So you show up as a tenant, like when's the last time someone occupied this building? Oh, 2 years ago. We know all the systems are bad because the building's been sitting vacant and everyone's just band-aiding it together. Like it's just it's a fire hose coming at you, and who wants to be the one standing in front of that? Not me.
Okay, so here's the math, and then we can wrap on this part of the pod. Using your estimate of a $20 annual net rent, which we have no idea if that's valid for Tempe, Arizona, but if that's the number, then the NPV, as you said, it's about just over $13 million in NOI cash flow over time. Using a 10% discount rate, the NPV on that is $9.88 million that you'd be willing to pay for that annuity. And I'm making the case that some local investor is going to apply some value. They'd be willing to pick up that asset that just had 130 invested in it for 75 a foot, 50 a foot. So at 50 a foot, that's another $6 million. You add that to the 9.8, you're willing to pay just over $16 million for the asset, $130 a foot, which is effectively a 15% cap rate on year one NOI and at $20 annual rent. If you're willing to ascribe a residual value of $75 a foot, then you're willing to spend $19 million. It's $153 a foot or a 13 cap rate. So I think that's just a really interesting exercise. I hope this isn't too wonky, but it comes to this idea that my original question, what's the cap rate it's going to sell at? I'm going to predict it's in that sort of 14, 15% cap rate range, which speaks volumes about investor expectations and investor enthusiasm, especially in Tempe, Arizona. And the fun thing about this little exercise, we can track this asset and see where it sells and come back to it on the pod.
Let me just add one more thing to throw a wrench into this whole thing. If you're a buyer, you're underwriting, what's my competition, right? So let's say Amazon moves out or the building becomes available. If any of you have been to Tempe recently or driven past Tempe on the way to the airport and you drive along the Salt River, you notice, the buildings that State Farm leased, and I believe they're called the Marina something. Anyway, Marina Heights, that is what it is. There's like 1 million square feet of primo, like Class A plus real estate, office space, right along the Salt River, right in Tempe, between 3 different buildings, much of which is available for sublease. That's not likely to lease anytime soon. Subleases run through 2035. Okay, so a lot of term left. I don't want to be competing against that. If you've been to Tempe, you've driven along the Salt River, you see these beautiful buildings that are brand new, that's your competition. Not a world I want to be entering.
Yeah, and I think it's really important, and I kind of glossed over this, it's really important to realize that if you are a buyer that's not a well-known entity, that doesn't have a track record, if we're approaching that building with my tenant, my advice to the tenant is to be cautious and to look at these buildings very differently than you look at a building that's owned by a professional landlord that we know, that has a track record, that has capital, that has a strong balance sheet, because you don't know the quality and condition the building has been maintained in, the building sits in. So you're already, even if the owner is a top quality and they perform as well as Boston Properties, say, and we don't know that, you're already at a disadvantage in terms of where the building is on a survey for a tenant, because that unknown could really cost you. And a lot of tenants don't want to go through the process of doing a building condition assessment and really understanding the quality and age of the systems. So you just take it off the list because there's much nicer buildings down the street being sublet by State Farm. So the ability to attract tenants early in a cycle is going to be really difficult. They're going to have to wait even longer or discount their rent so much that a lot of this risk is taken off the table. So it's a situation that gets very difficult for some of these unknown owners that may pick the building up at a song, but their ability to lease it is really challenged, in my opinion.
Okay, I'm gonna track that asset and I'll report back. Maybe the most likely outcome is it doesn't sell and it's taken off the market and current owners enjoy the lease and hope that Amazon renews. But I'm going to track it. I'll report back.
I want to talk a little bit about what's happening in the industrial market, just a little teaser for a future episode where we're going to do an updated deep dive into what's happening in the industrial real estate market, because it's really fascinating. And if you recall back in the beginning of the year, we all gave our predictions on what we think will happen to the industrial market throughout 2024, and the conditions are really softening. I mean, it's pretty fascinating what's happening. Obviously, there's industrial real estate in all of the markets where we each primarily work, and we do a lot of industrial projects in basically every single market around the country. But talking specifically about Southern California, what is so crazy is that if you look at the Inland Empire, the amount of available industrial space has almost tripled when you compare early 2022 to today, right? And vacancy is still, in the, very, very low double-digit percent, 11, 12%, or I should say availability is still in the 11, 12% range. But there was a time even in the Inland Empire where availability was sub 4%. And you're seeing the same dynamic play out in San Diego, in Orange County, in Los Angeles, and virtually in every other major industrial market across the country. You've seen availability rates go up by between, sort of at a minimum of like 20 to 50% across almost all of these markets. And you may say, wow, that's insane. That's so much space that's available. If you recall back in the early part of the year, many of us had the thesis of, hey, even if availability does increase by 30 or 40%, we still might be at 4 or 5% availability, which is very low. And that's probably not going to cause landlords to change their pricing expectations for the entire market, and that we're really going to see an availability need to go much higher than that. And we've sort of seen that happen. The other thing that's really interesting to think about is that if you look at the availability of sublease and sublet industrial space over the last 20 years, we are at the highest ever level in that 20-year period that we've seen. Granted, the industrial real estate market today, in terms of absolute square footage of space, is much higher. But today, we have nearly 200 million square feet of space available for sublease in the US. And back in 2010, we were more like 150 million square feet. So there are major signs of a softening industrial market. Rents are starting to come down, even if the asking rates aren't starting to come down. Landlords are being much more malleable, much more willing to work with tenants. Before, when a landlord might say, hey, we'll talk to you when your lease is 4 or 5 months up from expiring because we think the market's going to go up dramatically in the meantime. Now they're saying, hey, we'll talk to you now for sure. We'd love to have stability in the building. So things are changing. We're going to do a much deeper dive in a future episode, but just interesting to provide a Q1 wrap. A lot has changed in the last 90 days in the industrial market.
Yeah, I love to hear it. We each had our predictions, and it's important, I think, for a lot of our clients, a lot of our friends that are in the space, that pricing comes back down, right? So I look forward to the future episode when we dig in on this. But I had a really senior person in real estate, has been doing it for a long, long time, comment on this, and his analysis of it is this is kind of a trailing indicator of where Amazon went, and Amazon pulled back so heavily. The market takes some time to kind of absorb that and to let it flow through. But they are where Amazon goes, the market follows. And I don't have any data or anything to support that, but it's a very interesting theory, and I think he's right. I think it just takes some time for it to flow back through all of the different components of the industrial market. But with Amazon pulling back so heavily, the marketplace itself may continue to pull back. We'll see.
All right, we're getting close to wrapping up. I got a little bright spot for anyone that might be listening to this pod that is a property owner, particularly office property owner. The legal industry seems to be the bright spot. So rather, for some, counterintuitive thinking that they might be the ones leasing the most space, whereas tech has really led the market over the past, 5 years or more. Legal is the bright spot in the office space sector for those seeking occupancy. They have leased more space in 2023 than they did in 2017, 18, and 19. 16.9 million square feet of leasing occurred in 2023. It's a lot. And they're using more office space than those other industries that occupy office space predominantly throughout downtowns of America. And we're starting to see evidence empirically that in the past 2 years, they're the ones that are going back the most. And as a result, and I can say this, empirically from those clients that are law firms that I represent, they're the ones that are allowed to, or being able to make longer term decisions as well, because they're starting to see what their new footprint might look like, albeit maybe it's not as much space as they once had. They have a better line of sight over the next 3 to 5 to maybe 10 years a term, going, okay, like we're going to settle here, wherever here may be, and we're comfortable with where that might be. And therefore, let's take advantage of this market where we can secure truly phenomenal terms. I would suggest, in some respects, historic. The one fact that was teased out in this is that individual offices for partners have shrunk. Data shows that they went from about 225 square feet per person pre-pandemic to now what is 180 square feet per person today. So a little bit smaller in terms of office sizes. And of those leases, the 16.9 million square feet of law firm leases signed in 2023, here's a fun stat. 43% of those were expansions compared to 28.5% back in 2022, the year before. 27% had negligible change, meaning they probably just renewed or moved to another building with the same size, and 28% downsize. So just thought it was interesting. Most people think law firms as like more of like your father's firm, so to speak, and not the cutting edge tech that people are coming out of Cal Berkeley and growing insatiably. But law firms seem to be the bright spot of office occupancy downtown across America today.
Boston used to be a law firm and financial services driven market, right? It used to, and then tech took it over downtown, and now law firms are a big component and being chased widely by the investment and landlord community. And on a personal note, I have done an analysis on a particular large law firm here in Boston and provided it to them in the hopes of sitting down and getting a meeting, because I could save them probably somewhere between 20 and 30% on their leases up in like 3 or 4 years. And they're just not sitting down with me right now. So hopefully they listen to this podcast. I won't name any names. And hopefully they return my call and they review the analysis I did, because there's a lot of savings on the table. But in general, the law firms are very sticky, right? They're the tenant, the office tenant that moves the least historically. I think we did an analysis many years ago here, and it's something like 20 years the average law firm was in their space. It may not have been that long, but it was a long time. And landlords have always viewed them as a much higher probability to renew because of all of the hardware offices and the cost of doing it. But with so much second generation space coming online that reduces that cost, I think law firms are particularly in a great place to have more leverage when at times their leverage was limited either because of the availability of space, but also just because of the cost. Well, now there's other law firm space, there's other financial service space, there's a lot of space that has a lot of the amenities and build out that you could reuse with your own finishes that really create value to help you save money. So it's a great time for a number of reasons to be in the market early as a decision maker at a law firm.
I don't want to rain on your parade, Brian. Again, this is anecdotally for me as well, but something I've come to, I believe, understand or appreciate about the biggest and the best law firms is when it comes to their real estate decision making, saving money is probably not even in the top 3 of their priorities. Like, great space that motivates their team, client space can engage, fire up the youngest partners and associates. It's not about saving money. Ultimately, that's great if they can, but that's not a fundamental driver in some of the biggest prominent law firms with whom I've spoken.
If you can get all of that and save money, it's like, if I could give you $10 or put the $10 in my pocket, I'd rather put the $10 in my pocket, all other things equal. And that's the market we're in right now.
If I'm an executive director of a law firm today, okay, and my peer firms, those that are about the same size as me, are out executing historic terms on their office leases, lowering their cost basis for running their firm because real estate is probably the second biggest line item on the balance sheet. And I'm locked into a long-term lease and I'm not able to take advantage of this market. Pardon me, but that keeps me up at night because I can only raise my comp so much. Okay. And I can only raise my billable hours so much. So it's both being competitive against my peers for the work that we're all trying to, go after, and also how much I can charge and how much I can pay my people and how profitable our firm is for those that are partners. So I'm going to just respectfully disagree that cost is a huge component, especially if I'm not able to capture the terms that my competitive firms are capturing today. But that's for another pod. Healthy debate.
One more thing. I just saw I think it was the Journal, talked about $2,000 an hour being the new normal in New York City for law firms, right? So you can't just, to Owen's point, you can't keep pushing those rates higher. And the only other way to make partners more money is to reduce costs. So if it's not important, John, and you're the guy in charge and you walk into the partner meeting saying, real estate, whatever, and everybody else around you, you're not going to have a job much longer.
What I said was from firsthand experience in talking with one of the largest and most prominent national law firms is that it's not in the top 3 of the drivers of the decision making. It's important. I'm just not sure you're going to land that meeting by leading with cost savings. There's a lot of other things that are important in their decision about long-term real estate, keeping partners happy, keeping clients happy, keeping the associates happy, and cost factors in. I merely said it wasn't in the top 3.
It might be the 4th, according to JJ. Yeah. Okay. Still important. 4th still matters. We will wrap up there. Thank you, everyone, for listening to episode 32. We'll be back soon.